Okay, let's go. It's 5 o'clock, and welcome everyone. If you can hear me. Yes, right. So welcome everyone to the TEDx Gateway session. We are talking about the world has changed, and we've been looking at many aspects in and around this theme. We've looked at investing. We've looked at health. We've looked at mental health, and every aspect of this is important because we really don't know what the world is going to look like in a month's time or 2 months' time, or God knows when things start settling down finally. So one aspect that people are obviously very interested in is how are economies and financial markets going to perform? More importantly, is there anything that we can learn from history? Is there anything that we can take away from what we've experienced in our past, or what our extended families and friends and associates have experienced, and how do we put that learning to any application, if at all? My guest for today is someone who's written on the investing history of investing. He's written on the psychology of investing, and is perhaps very well placed to look at investing as a theme, as a concept, and understanding how you and I can really put our best skills forward when we try to really put our money and try and make it work. So I welcome today Morgan Housel, partner at the Collaborative Fund, and also a former columnist at the Motley Fool and the Wall Street Journal. And I'm going to hand over to Morgan Housel, but amongst the many things he said in his articles over years, one thing that, or one of the things that has stayed with me is the statement that investors were probably better informed 20 years ago when there was 90% less financial news. And that's perhaps a good way to start off to you. Thank you all for joining in. Let me add my thanks to the TEDx team for inviting me to host this discussion as well. Over to you, Morgan.
Well, thank you very much, and good evening, everyone. Good morning for me. Thank you for taking out the time to be here. I'm looking forward to chatting with everyone. I'm going to share my screen because I have a few slides here to share with everyone. So let me just pull this up real quick, and I'm going to have to start my. Well, let's see here. Let's see. Bear with me one moment while I have to move the bar down here a little bit more. Let's see that. There we. Okay, here we are. Thank you very much. I want to discuss what is happening in the world and what might happen next. And I think we have to discuss and mention and admit when we are talking about what's happened in the world that we are dealing with today at this moment the most serious global economic crisis since the Great Depression, if not even exceeding that already. What has happened in the United States and of course around the world is literally an order of magnitude greater in severity than what we saw in 2008, which we thought at the time would be the economic crisis of our lifetimes. Just in the United States, we now have 26 million people unemployed, probably equates to about a 20% unemployment rate, which is as high as it got in the Great Depression in the 1930s. But even then, it took about 4 years to get to that point. We hit that in 4 weeks. So the severity of it is just incredible. In 2008, the most weekly unemployed that we had, the most number of new unemployed in a week was about 500,000. And whereas for the last 5 weeks, it's been above 5 million every week. So literally 10 times worse than anything we saw in the Great Depression. You have in the United States something along the lines of 80% of restaurants and other small businesses that say they will not survive if this lasts more than a couple more months. So it's hard to overstate how severe what we're going through is right now. But I mentioned that with a very important point, which is that I'm actually still pretty optimistic about the long-term future. You can admit that what is going on right now is a catastrophe in every sense, while still remaining fairly optimistic about the future. So I want to bring up this phrase that I think about a lot, which is realistic optimism, which is just trying to define what is optimism. Normally, if you say you are optimistic, people will think that what that means is that you think things are going to be good going forward. And I actually don't think that's what optimism is. That to me is complacency. If you think everything is going to be good in the future, that is being complacent. What realistic optimism to me is the acknowledgement that what we are going through and what is going to keep happening in the future is going to be almost a constant chain of setback and disappointment and crises and problems that people are dealing with individually and all around the world. But that those setbacks do not preclude long-term growth. And that even though we're going through a constant chain of setback, that does not take away from long-term growth. That to me is what realistic optimism is. A pessimist is someone who thinks that the setbacks do impact long-term growth. An optimist is someone who thinks, look, things are always going to be bad, but that's okay. Let me give you a historical example of this. This is Germany's GDP, for about the last 130 years. 150 years or so. And what I think is really interesting about this chart is, of course, the big dip in the middle, which is World War II. At the end of World War II in 1945, Germany's GDP had been reduced to back about where it was in 1880. They lost about half a century worth of economic output. Their economy was just completely decimated at the end of the war. But you can see from that chart, it only took about 2.5 years for their economy to recover back to post-war output. I guarantee you at the time, no one thought that it would recover that quickly, that to effectively rebuild their entire economy would only take 2.5 years and they would be right back to where they were. And actually their growth after the war, as you can see there, exceeded their previous trend. This is what I mean by realistic optimism. You could admit in 1945 that Germany was a complete catastrophe economically, but it only took 2.5 years to recover all of it. Now, those were a difficult 2.5 years for people, of course, but this is what I mean by massive setbacks not taking away from long-term growth. This is also true in the United States. This is our real GDP per capita, our wealth of the nation going back to the 1850s. So a very long view here. And this is, of course, a tremendous amount of growth. Our standard of living increased 200-fold during this period. Tremendous amount of growth. But if you look at what went on during this period, it's just a constant chain of setback. During this period, you will see that 1.3 million Americans died while fighting 9 major wars. You'll see that roughly 99.9% of all companies that were created went out of business during this period. 4 US presidents were assassinated during this period. There were 33 recessions that lasted a cumulative 48 years. The stock market fell more than 10% from its previous high, at least 100 times during this period. It lost 1/3 of its value a dozen different times. Annual inflation exceeded 7% in 20 separate years. And the words economic pessimism appeared in newspapers 29,000 times during this period. So even though it's a tremendous amount of growth, just the most growth that we've ever seen in the history of the world, it was bad news all the time. This is what I mean by realistic optimism. And I want to give you a story that has nothing to do with investing or the economy, but will help, I think, wrap your heads around this idea of long-term growth amid constant setback. And the story has to do with baby brain development. The average child is born with about 100 billion brain neurons. And each one of those neurons has about 3,000 synaptic connections. These connections to other brain neurons that form this web of intelligence inside of your head. So maybe when you were born, that web of knowledge looks something like this. You have a web of synaptic connections in your brain. By the time the average child is 6 months old, that has increased from 3,000 to about 6,000 synaptic connections. So the amount of growth going on inside your head is just exponential. You're gaining a lot of intelligence. By 2 years, that's increased from 6,000 to about 10,000 synaptic connections. So a tremendous amount of growth that takes place in the first 2 years of a child's life. And then after 2 years, something very interesting happens, which is that the density of synaptic connections in your head, the number of connections that you have inside of your brain does not just plateau, it starts to decline, and it declines fairly rapidly. By the time the average child is 4 years old, they've already lost about a fifth of the synaptic connections that they had when they were 2. By the time the average child is 6 years old, they've lost about a third of the synaptic connections that they had when they were 2 years old. This keeps going on all throughout your childhood and your adolescent years into your early adult years. By the time the average person is 20 years old, they have lost half of the synaptic connections that they had when they were 2. Why does this happen? Well, it turns out that a lot of the learning that takes place in the first couple of years of your life and these connections that are taking place are connections that are redundant. They're not necessary. You're learning things about the world that are not very practical. Sometimes these connections are just completely miswired inside of your head. And so you go through a lot of the early years of your life getting rid of these inefficient, unnecessary, impractical connections in your head. That is why the number of connections is declining. You're wiping out the things that you don't necessarily need anymore. But what is very important about this and how this ties back to the economy is that even though what is going on inside of your brain is loss and chaos and destruction, you're still getting smarter. A 4-year-old is much smarter than a 2-year-old. And a 20-year-old is much smarter than a 2-year-old. So even though what's going on inside your head is loss, you are getting smarter. Now, that is not an intuitive thing to think about, that even though it's a constant chain of loss and destruction, you are improving. But that is the normal path for a lot of things for how they grow. That, again, is I think, the definition of what I would call rational optimism, growth amid loss. This is very true for something like the stock market in the United States. This is the S&P 500 going back to 1957 when it was when it first came about. And this is like the picture of success for a large developed nation's economy. This is as good as it gets. You made about 200 times your money during this period. Of course, there's some volatility, but this is as good as any large country can hope for. But this I want to show you is when the market was down 5% from its previous all-time high. That's when it's down 10% from its previous all-time high. And that is when it is down 20% or more from its previous all-time high. So you start with as good as it gets, as best as anyone can hope for. And then you look at what actually went on inside of the market during this period, and it is a constant chain of loss and disruption and misery and decline. So those two things are not mutually exclusive. That is actually the natural path of growth over time. One of my favorite quotes is from Dwight Eisenhower, former US president, who was once asked the definition of a military genius. And Dwight Eisenhower said, a military genius is the man who can do the average thing when everyone else around him is losing his mind. And I think it is the exact same thing in investing and when we're thinking about the economy. That to understand what's going on in the economy, all you need to do when the world is falling apart, as it seems like it has been in the last 2 months, is to do the average thing, the calm thing, and realizing that is what is going on is destructive and it is painful and it is incredible to watch. It can be stressful to watch, but it can actually be the normal path of growth over time. And what that does to the world that we're going through, one of these big chaotic episodes, I think there's really two big things that will come out of this for how the world will change in big ways going forward. And there's two things that I think will happen from here. And I'm just going to sum them up as savers and innovators. The first thing is for savers is that I think we are going through, particularly since we just went through 2008, just over a decade ago, another big economic collapse where people lost a lot of money and lost a lot of jobs. The fact that we are dealing with this just 10 years later, I think is going to leave a permanent scar on people and inhibit their ability to a greater degree to want to take a lot of leverage, to take a lot of risk. I think people are going to have a much higher propensity to save money and avoid debt and avoid risk going forward. Very similar to what we saw during the Great Depression in the 1930s, where an entire generation after that wanted to avoid debt. They weren't investing in the stock market as the numbers that they previously were. They did not want to take a lot of risk. It left a permanent scar on them. So even though the wounds in the economy can heal, there will be permanent scars that are left. And one of those permanent scars is, I think, a society that wants to save more money and utilize less debt. Now, that might inhibit some economic growth over time if people are not willing to take as much risk over time. I actually will also think that it'll make people more financially robust over time, more able to handle these setbacks when they occur. So there's actually two sides of it, and I think on balance, those will balance out to a healthier society than we were in the past. I've seen a tremendous number of businesses, excuse me, and individuals in the last couple of months who were maybe a business that was at an all-time high in February, record sales, record stock price, and in March was facing bankruptcy. So those are very fragile businesses. And I think learning from that is going to create more robust businesses, more robust consumers going forward that have a higher propensity to save. The other, just in terms of innovation, is that it tends to be the biggest innovations over time, the most useful innovations over time, do not come when the world is going well, when everyone is cozy and everything is good. The biggest innovations come out of panic-driven necessity. So the most innovative decade that we ever had in the United States, the most innovative period, was the 1930s and 1940s. The Great Depression, when people said, the world is falling apart, I just lost my job, I just lost my business, we have big problems that we need to solve in the world, that is what creates the fuel to really innovate in a very quick and dramatic way. The other was World War II, which started on horseback and ended with a nuclear bomb. Just a tremendous amount of innovation that took place during that period because it was a necessity. You had to figure out how to do things better and do them very quickly. And I think it's similar right now, where we have this global crisis that has a common enemy that everyone in the world is trying to solve. And right now, you literally have every pharmaceutical company in the world trying to fight one virus. That is when you get a level of innovation that I think we have not seen and since maybe the end of World War II, that you're just going to have a tremendous amount of panic-induced innovation going forward. That, to me, is also a very optimistic thing to think about, that I think we're going to see the most innovation literally in the next 24 months than we have probably in the last 10 or 20 years in the world. So that is, I think, the two biggest ways in which the world is likely going to change from here going forward. There's so much, of course, about COVID-19 that we don't know yet. The world is changing so quickly that we don't know about the economy. What number of people who have been laid off from their jobs are going to be rehired when the economy opens? Even when the economy opens, are people going to go to restaurants? Are they going to travel? We don't know a lot of these things. But those two big things, just from a macro perspective, are what I think about. People are going to be much more inclined to save money. And I also think we're going to see much more innovation in the years ahead. So that is how I would wrap up my comments on what I would say is rational optimism about where we are today. A recognition of how bad it is, but still the ability to remain optimistic about where we are going to be going forward. So I'll be happy to take some questions from now from both the moderator and the audience. So thank you.
Right. Thank you, Morgan. So, you talked about some fundamental changes, particularly linked to travel, discretionary income, and everything that we do in the order of leisure. So, and there have been a lot of questions along those lines as well, and I'll read out a few of those. But you are saying that there could be some fundamental shifts that we may not get out of, and that and that's something that I want to hold on to. And is that going to change? And what's your sense in terms of how that's going to change or affect the fortunes of businesses who are involved in that? I mean, do you see them innovating their way out of that? People have asked, for instance, about concerts. And it's an illustration of a small maybe it's a small business or a slice of a slice, but it represents something that can fundamentally change and may never come back or may not come back for a long time.
So I think we have to separate two different periods here. One is probably the next year when we almost certainly do not have a vaccine, and the other is, let's be optimistic and say there is a vaccine within 18 months. It's not a guarantee, but let's say that. Certainly, but in the pre-vaccine world, anywhere that you are gathering more than about 10 or 20 people is going to be significantly inhibited. Restaurants, bars, concerts, sporting events will be significantly inhibited, if not effectively shut down. I think restaurants where you can situate the table so that you are sitting 6 feet away from the other guests, that is one thing. But if you're talking about a sporting event where there are 50,000 people sitting right next to you, even if they are allowed by the government, no one's going to want to go to those. It's not going to come back. Same with like a bar, where the situation of a bar is you're standing 2 feet away from everyone, 6 inches from everyone. Those things I think are going to be very inhibited in the coming years. And then in the post world, I think, when there is a vaccine, I still think there's going to be a sense, even if everyone is vaccinated from COVID-19, that people are just much more aware of viral illnesses than they were before. A lot of people, particularly in the Western world, thought that these pandemics were a thing of the past. And now that we know that they are a part of our life, it's still going to be a part of our willingness to hang out with strangers going forward.
Right. And how does one, I mean, when you look at either company stocks or sectors, how do you, because a lot of this is perhaps not apparent to us today. You talked about restaurants, we talked about concerts, we talked about travel, airlines, and there is a long tail to it. There is an upstream and there's a downstream, all of which is going to get affected, and to the extent that we perhaps even don't know right now. So how does one begin, and how does one take bets at a time like this?
I think we have the future has never been more uncertain economically, particularly at the individual business, individual sector level than it is right now. So my broad answer would be proceed with caution when you're doing that, and not necessarily caution, but proceed in a diversified way. There are a lot of investors before this who were, had 80% of their money in energy or 80% of their money in tech, and those specific sector bets become much more risky than they were 2 months ago, because we don't know what's going to happen. Even if you look at something like Zoom that we are using right now, Zoom as a company has exploded in the last 2 months. They went from 10 million to 300 million users. Is that going to stick around after the economy reopens, or are half those users going to disappear? So even a beneficiary like Zoom, I think we just don't know how much that's going to stick around. There are certainly within sectors too, there are going to be a tremendous number of restaurants that don't make it. They're going to go out of business. There's also going to be restaurants that figure out a way to increase food delivery, figure out how to situate their dining room so that people can sit far apart, start handing out masks to people that will not only make it, but they will thrive. So I think it's just very difficult to say this industry will do well, this industry won't.
Okay.
Yep.
Right. So, you talk about saving, you talked about permanent scars, and you said, people will save more and utilize less debt. And that, I'm assuming, will apply to corporations as well. On the flip side, I was talking to Nilesh Shah, who's a well-known fund manager here, on the same platform a few weeks ago. And he was saying from his perspective that obviously he would look at companies that are less leveraged and obviously do not have the kind of debt exposure that could cause problems down the line. And we are seeing some of that, and there are some questions to that effect as well today. So how does one then try and find winners at a time like this, where you're faced with seemingly impossible options?
I think for the first time ever, the most important metric that investors around the world are looking at for both public and private companies is how long can you survive with no sales with the cash that you have on your balance sheet. That metric has never been even thought about, but it is the most important metric in the world right now. One of the big reasons that the S&P 500 in the United States has done so well, it's actually almost up in the last year, if you can believe that, with what's going on. The market has increased in the last year. The NASDAQ is actually up year to date, if you can believe that. A lot of the reason why that is because those indexes are heavily constituted by Microsoft, Apple, Google, Facebook, these companies that have incredible amounts of cash. Those 5 companies that I just mentioned have over $600 billion of cash on their balance sheets, which is more than our federal government set aside to bail out the other 20 million businesses in the United States. So whenever you have a company that just has an amount of flexibility on its balance sheet, low debt, high cash, those are the companies that are going to have the ability to figure out their future. So that metric has just never become more important than it is today.
Right. And, we were speaking earlier, and you talked about this new class divide that's going to emerge between those who work from home and those who do not, and what's the downstream impact of that. So talk to us about that. And there are a couple of questions around that as well from Ajit Bhaskar, who asks, work from home, digital delivery, preferred model for the service. Will it be the preferred model for the service sector? And there are similar questions as well. But essentially, I mean, quite a few questions asking how the work from home matrix is going to change lives for us and for organizations and for the economy.
Yeah, so I think there's 2 really important parts of this. One is that for businesses and for people, they're going to realize that once this is over, that a lot of businesses are actually operating just fine with every employee working from home. They're actually doing great. Their sales have not been, they can still maintain their businesses, perform their operations. And so when this is over, you're certainly going to have a lot of corporations that say, why are we spending so much money on this expensive office building when our company did just fine with everyone, with no one using it? So I think certainly commercial real estate companies like WeWork and whatnot that are relying on that are going to be in a world of hurt after this. They were already hurting in many ways before this, but you're going to have a much greater sense of people saying, working from home is okay. Not 100% like it is right now, because if you have kids and whatnot, it's tremendously difficult to work from home. So it's not 100%, but certainly to a much greater degree than anyone ever than anyone ever assumed. The other thing that's really important from a social level about working from home is that one of the biggest stories, economic stories globally for the past 20 or 30 years has been the rise in income inequality, just the separation between classes that has grown tremendously. And that separation is, I think, about to explode even higher to the greatest degree it ever has. Because just in the last 6 weeks, society has been cleaned into two separate buckets. Can you do your job from home or can you not? And some people get to continue their job, getting their salaries, getting their health insurance benefits, and other people are unemployed. They've lost their paychecks, they've lost their dignity. And by and large, the jobs that you can perform at home are the knowledge jobs that have already done well in the last 30 years. Tech jobs, lawyers, accountants, financial professionals who can keep doing their jobs at home and earning their money like they had before. The jobs that by and large cannot be done at home are the lower end service jobs where you can't do them at home. Whether you are a manufacturer worker or a waitress or a bartender, you just can't do those at home. And that just exacerbates what was already, I think, the biggest problem in the global economy for the last 30 years.
Right. And three questions actually, which sort of cover that. And I do want to acknowledge them. Sanjay Daswani, Devesh Dhawan, and Krizane Chandy. They all ask, one is, how do we reskill ourselves at a time like this? What is the most important trait as an individual or as an organization to come out stronger? And top tips for professionals.
I think one thing that might kind of summarize all of those is that, there's a difference between getting rich and staying rich, if you want to phrase it that simply. And that getting rich requires taking a lot of risk and swinging for the fences and your ability to be optimistic about the future. Staying rich is almost the opposite skill set. You need to be paranoid and conservative. And so I think marrying those two together are the people who do very well over time. So if you're looking at a company or a career or your personal finances, I think right now is really the time to really focus on the other side of the barbell, the staying rich side of the barbell, your ability to endure. So I think, to the extent it's not very good advice for people right now. It's like it's saying you should have done this in the past, but people in general underestimate how much cash they will need at a personal and a business level. A lot of people will say, cash is not earning any returns. I'd rather put my money in the stock market and earn a higher return. People tend to underestimate the ability to be impacted either personally or for their own business by a big catastrophe like this. So I think if you have the flexibility within your personal finances or in your business finances to be able to give yourself the flexibility to control your time so that you can either learn a new skill because you don't have to go find a new job tomorrow to keep paying your bills, or as a company to have the flexibility to retool your operations, learn how to do something different. Those are the companies that are going to thrive. I already mentioned something like Google, Facebook, Amazon, those companies that have so much cash, they can figure out a new way to do business because they have so much flexibility on their balance sheet. Very different for companies that have debt payments due next month and they just have no options right now. So I think people will learn from this. This is probably the biggest takeaway going forward. Is that the return on cash, the return on flexibility is enormous when you meet a tragedy.
Right, and there are a lot of questions about China and India, and I'm going to come to that. But just a sort of reality check. Nishant Varshne asks, he says, "Be honest and let us know how bad we've got hit."
I don't think I can use a word strong enough. It's as bad as it's ever been in our lifetimes. There's no other way to put it. I think in some instances, it is worse than the Great Depression in the United States, particularly because, like I said earlier, in the Great Depression, the unemployment rate got to 20%, but it took 4 years to get there. We got there in 4 weeks. So in many ways, it's worse than that. It's interesting this time because the stock market has not collapsed so far. It's had a huge rally in the last couple of months. We have not had a lot of financial impacts in our banking system, our financial system. Our Federal Reserve and central banks around the world are flooding the system with cash to prevent the financial system from collapsing. But in the employment markets and in the small business markets, it's devastation like we've never seen ever before.
And you talked about the push from the central banks, and questions have come on that as well. Mukul Agarwal asked, will these financial packages push asset prices and create bubbles?
I think they already are supporting asset prices. Will they create bubbles? That I don't know, because a bubble, I think, is a very specific thing where an asset price gets so high that after it collapses, it will never recover. We're not seeing anything like that right now. We didn't see anything like that after 2008. But if you were to ask me, our stock market in the United States is up about 30% in the last month. Is that because our Federal Reserve is injecting a bunch of liquidity in the system? That's certainly one reason why it is. And that's by design. That's what the Fed is trying to do. So I don't necessarily think it's going to create bubbles. To create a bubble, you need a lot of consumer participation where people just think the future is as good as it's going to get. You don't necessarily get bubbles from Fed participation alone, but I think the Federal Reserve and central banks around the world will support asset prices to a degree that did not exist before 2008. It certainly didn't exist in the 1930s and the Great Depression, when our stock market fell 90% during that period, when there was virtually no central bank support.
Right. And there have been, again, a couple of questions around the US dollar, and do you see it continuing to hold its where it has been in its preeminent position, or do you see that weakening?
So this was the same thing in 2008, where a lot of people kind of said, similar to as they're saying now, that when you have a global banking crisis like this, a global financial crisis, global economic crisis, that is when the dollar is going to lose its preeminency. And it might. I don't have a firm forecast on what that's going to do. But both in 2008 and in the last month, we saw the opposite. And the scramble for dollars, the desire for dollars, has been the strongest it's ever been. And the strength of the dollar relative to other currencies is the strongest that it's been in many years. So it's certainly possible, with the deficits that we're running in our central bank policy, that the dollar will lose value over time. That's certainly a case. But it was not the case in 2008. And so far, it's definitely not the case right now. So it's not as clear cut as I think a lot of people make it out to be.
Okay, so we are at halftime now. So let's pick up the China questions. Can India replace China as the new manufacturing hub post-COVID? Asks Assis Isor. Can India be a superpower by 2025? Ask actually three people: Gautam Burke, Zishan Hassan, and Piyush Jain. And will companies move to India or move their businesses to India from China?
I think my broad answer to most of those questions is yes. And I say that for one reason. And let me summarize it. And this is really kind of my only view on China and India right now, is that all that matters for economic growth over time, this is true for everyone, is two things: population growth and productivity growth. Those are the only thing. That is how you grow an economy. You either add more people or you make those people more productive. China right now, in terms of population growth, has some of the worst demographics in the world. China's working age population is set to decline by 200 million between now and 2050. So a tremendous decline, similar to what Japan has gone through in the last 20 or 30 years, that put a cap on its economy. India is, of course, the opposite. India has incredible demographics in terms of population growth over time. So from an economic perspective, there is no precedent in world history for a country like China to have a massive decline in its working age population and have that not put an incredible headwind on its economy. So the next 30 years for China, I think, are going to be very difficult economically, just from a demographic perspective. Now, if you were to look across the entire globe and say what regions have the most favorable demographics in terms of economic growth, it would be Africa and India. That's it. And India certainly has a much more advanced technology situation, infrastructure situation, than a lot of the regions in Africa do. So certainly, if you're going to look at the next 30 years, just from that basic, simple construct, I would be much more optimistic on India than I would China. And could it become a superpower? Absolutely, just because of that dynamic alone.
Right. And the sort of extension to this question, and Rohit Himatsinka asks this, do you see the movement of the supremacy of the United States and Europe to Asia by the time this scenario ends?
Of course, I'm biased in this, and this is going to affect me. But I think I think it will slowly. I don't think it's going to be a sudden collapse that would probably be precipitated by a war, something like that. Of course, that's possible, but I don't think it's going to. Rather than a collapse of American power. I think what is more likely is something to what the United Kingdom went through 100 years ago, where the United Kingdom in the early 1900s was the king of the world. It was the most powerful nation in the world. And then it slowly eroded its power and kind of slowly handed it off to the United States. World War II was like the big handoff. But I think that slow decline is probably what we are likely to see in the United States rather than a sudden collapse of power that shifts. Certainly that could happen. I hope it does not, but that would be my estimate for what's likely to happen in the United States.
Right. So here's a question about you. And if you were to invest now, or if you are investing now, Sandhya Naidu, I think, asks, and aimed at the collaborative fund, what would you be looking at or are looking at?
Well, look, from a personal perspective, how I invest my personal money is I dollar cost average into broad-based low-cost index funds all the time. And so I'm still doing that as the economy is imploding in the last couple of months. I will always do that. Dollar cost averaging, where you're investing the same amount of money and at similar intervals, that only works if you do it all the time. So that's how I look at the world. And I view owning broad-based index funds as just owning a slice of global capitalism, which I still believe in. I'm realistically optimistic in. So that's how I think about it from that perspective. From, if you're looking at collaborative fund where we're investing in startups at the seed stage, things are changing much more dramatically at that level than they are. But as I invest my personal money, which I think is going to be more relevant to most of the people listening to this, it's just a bet on long-term optimism in humanity and keeping things very simple, very low cost, very diversified and broad-based, and doing it consistently, which I still am.
Right. There's a couple of questions, and this is it's interesting because, it was put, the question here is, asks about the long-term impact of depression on youth. And in a way, this raises other questions as well about how are people likely to come out of this, and in what shape and form will they come out? You've talked about some of the things to do with the way we invest, the way we save, the way we think about our future. But do you see other longer term impact, which obviously will then play into our fundamental behavior, and or some things which may actually take a longer time to recover from?
Absolutely. And there's a lot of research on this, that if you begin your career during a deep recession, so the young generation that's exiting college.
So that question was from Ankit Trivedi. Yeah, go ahead.
Thank you. That will stick with you for life. And there's actually a lot of research that's been done about this, particularly for people in the recessions in the 1970s and 80s. They track them for the rest of their life. And people who began their careers during that period never had the kind of career success that people who started their careers when the economy was strong. It does something to your optimism, to your well-being, that will stick with you forever. So I think it's absolutely the case that is going to be that's going to stick with the generation. There's another important point here, in that there's kind of my generation who started their careers around 2008 when the economy was really weak. A lot of people from my generation never really recovered from 2008, and now they're being pushed down by 2020. So you have this double whammy that I think is going to really stick with people for a long time and inhibit their careers, but just inhibit their optimism to a degree as well. That, again, as I said, will increase their willingness to save, will decrease their willingness to take risk. And that has economic consequences. To me, it's less about the economic consequences and more about the social consequences of having an entire generation who is less optimistic about our ability to solve problems in the world than previous generations were.
Karthik Iyer asks, will you invest now or will you wait for a vaccine to be found?
So I'm investing always. Whether there's a vaccine or not, I'm going to keep doing it. And look, when the world is falling apart and the markets are down 30%, that's not fun to deal with. But if you keep investing during those periods, those are the investments that are end up going to do the best over the next 10 or 20 years by having a lower cost basis to buy them in on. So no matter what's going on in the world, no matter what is going on in the world, I'm going to keep investing consistently to the extent that I can. Sometimes when there's a very big decline in the stock market, I will invest more than I typically do. But by and large, I just keep it mechanical, invest the same amount of dollars every 2 weeks, regardless of what's going on.
And I guess what people are also trying to ask, and I've seen it being asked elsewhere, Morgan, is that, can we stay invested? Has anything so fundamentally changed that we should walk away from investing, walk away from looking at stocks, and maybe go and put all our money in the bank? or
I think
under
that's
the
a
pillow?
very personal question,
Yeah.
because broadly the answer is no. Nothing has changed that would preclude me from investing in the long term. But it's a personal question because there are some people for whom, if they don't have a tremendous amount of assets, if they just lost their job and they have some big expenses coming up, that they might need to. There's a great writer from the New York Times named Carl Richards who has a quote that I love. He says, "Personal finance is more personal than it is finance." So whenever we ask these questions like, what should I do with my money? You can't give a blanket answer. So if you are someone who really needs the money that you have in the stock market, if you are going to need that cash to pay your bills over the next 3 years, then I think it's okay to bail. But if you are someone who does not need that money over the next 3 years, nothing at all has changed in the economy that would make me think that the long-term growth that has occurred in the stock market over the last 200 years has been disrupted to any degree.
Right. And a couple of slightly specific questions. Do you see stock prices crashing once the financial performances of companies are revealed, which is the next quarter? And how do you see the future for companies in the sharing economy or the gig economy, like Uber, Airbnb? That's Mohit Chabra and Manish Gupta.
Yeah, great questions. I don't tend to predict what the stock market's going to do in the short run, but let me just make an observation that every investor right now knows, as a matter of fact, that the next 2 quarters at least are going to be a complete washout for virtually all companies. Even really good, high quality companies are going to lose a tremendous amount of money. That's not going to surprise anyone. So when those results are actually announced, do I think that's actually going to make the market crash? I think most investors are already anticipating that. So I don't necessarily think that's going to be a huge deal, although it certainly could. The sharing economy is very interesting because if you just think about something like Uber, how many people, particularly before there's a vaccine, are going to want to sit in a stranger's car? Very, very few. But on the other hand of that, what options do they have? You can get into a normal taxi cab. You can get into a subway system. There aren't a lot of options. So I think those companies will be hurt, but they will not be crushed because people will just find a different way to do things. Everyone will be wearing masks and gloves, and there'll be hand sanitizers, et cetera. But I think a lot of those companies serve necessities that are going to be very hard to just do away with.
Right. Morgan, many of the questions, as I can see, are really about people speaking from what they are going through or what their children are going through or likely to go through. And let's pose them. I mean, they may not be completely connected with the way the financial markets will play out or behave, but I think it's important. So many of them are to do with education. How is it going to impact jobs? How is it going to impact students' graduation? Will students plan with the same enthusiasm for preparation of master's study? As placement will be a challenge. Harshil Badra asked that question. Sunshine Manglani asked that question. And I've got a few more, all asking about education. And then on the flip side, there are also people saying, is there opportunity for education?
Yeah, certainly there's opportunity in the sense that online education was already growing before this, but now it's going to surge going forward. But I actually I don't think that is going to significantly disrupt the traditional education system of going to college and getting your degree. That is such a fundamental part of being an active member in the economy these days, particularly, this is true all over the world. That is not going to go away. And it's not only true for the importance of your economic life going forward, but for a young person, it is the central part of their social life as well. So the idea that people are going to say, I don't want to go to college anymore and meet all these new friends and live in a dorm and have these great experiences, I'm just going to sit at home and do my learning online. I don't think that's ever going to be a winning argument. So online education will grow tremendously, but I would still remain very optimistic on traditional in-person colleges. Those colleges, though, are in a world of hurt right now, because you have a lot of students who are demanding refunds for this semester where they had to stay home, and next semester they might not be able to reopen at all. And even though a lot of those colleges have huge endowments, they are fragile too, like companies. And if you take out 1 or 2 semesters of revenue, they are in a world of hurt. So I think you're probably actually going to see a lot of small colleges, leave aside Harvard and Stanford and MIT, a lot of the smaller private colleges in the United States that will go out of business. They will cease to exist in another year.
Okay. A question on small enterprises from Jimit Modi. He says the US economy and a lot of large businesses depend on the strength of small and medium enterprises. Even businesses like Google and Facebook, which are essentially advertising businesses, depend on this SME segment for ad revenue. How badly is that segment affected? And how many of these US SME businesses will permanently perhaps go out of business?
I think that is the main difference between right now and 2008. In 2008, it was started with big companies, big banks, and worked its way down to the small companies. This is starting with the small companies working up. So big companies are in a much better position than small companies today. And they're in an absolute world of hurt. It would not surprise me in some industries like restaurants and oil and gas to see 50% or more of these companies not make it out of this. The flip side of that is you can look at the devastation that they are going through. But in the United States and around the world, there is so much stimulus being thrown at these companies to keep them up. In the United States and the UK and most of Europe, the government is effectively just taking over the payroll for these companies and saying, we'll pay your employees. Don't worry about it. Tremendous amount of forbearance that's going to go on in the bond market and whatnot. So they will, there's a lot that's trying to keep these businesses propped up. I think a bigger thing, even if they can financially remain active, is that a lot of these companies, particularly in the United States, the small businesses, are owned by baby boomers who are already heading into retirement. They're in their 60s or 70s. A lot of those owners will look at this, and even if the economy recovers and they are able to make it through, they will look at it and say, this is too stressful. I don't want this anymore. I'm going to retire and close up my business. So between those two things, between a lot of companies that won't make it financially and a lot that will just choose to not come back, there's going to be way fewer small businesses coming out of this than we had going into it. And what that's going to mean is that big businesses will be more entrenched than they were before. And I think if we were to look ahead at the economy 2 or 3 years from now, we will see that big corporations make up a larger share of employment and the economy than ever before, particularly for employees too. If you think about someone who's looking at job options and they can work for a small company or a big corporation, and they look at this and they say the small corporation went out of business very quickly, whereas a big corporation has stability and good benefits and a good salary. That's where I want to work. So I certainly think that small businesses will be a smaller share of the economy going forward. And that's not a good thing because so much innovation and dynamism comes from small businesses in the United States relative to corporations.
Right. And there's a question from Tushar Agrawal on who asks, will this crisis push globalization to the backseat? But let me tie that in a little differently. So you talk about big corporations, and a lot of the growth for big corporations in the last few decades in the United States has come from globalization. And growth and profits have come from typically, or most of their profits have come from outside the United States rather than within, and continue to do so. And if with the nature of globalization changing, and for other reasons, including the fact that you have, let's say, President Trump, who's been asking for some form of delinking, new trade equations, and so on. So what is all of this going to mean? I mean, one is the impact on globalization, but also the impact on companies and their bottom lines, which were dependent on globalization all these years.
I think you hit the nail on your head when you brought up Trump, because this path was already going before any of this happened. Certainly from Trump. Now he might not be president in another 6 or 8 months, so maybe that will go in a different direction. But there already was a movement towards delinking globalization before this, and certainly in the United States, we have realized in the last 2 months that a lot of the supply chains that we desperately need in terms of medical equipment, masks, gloves, we don't make any of that stuff in the United States. We rely on other people, and that I think will certainly at the political level and the company level, the corporation level, will be a desire to bring more manufacturing capacity back in the United States, which is something we've already been trying to do for a decade now, because manufacturing jobs tend to be high wage, good jobs. We want to bring more of those back. I think this is going to supercharge that. I don't think that's necessarily a good thing. And I don't know if it's going to go to a tremendous degree, because there is so much efficiency that comes from globalization that most corporations will not want to give up. The efficiency of diversified supply chains, the amount of investment that has already been put into globalized, global supply chains, will be very difficult to unwind completely. So it's certainly going to be a trend towards bringing that back, but I don't think it's going to be a wholesale unwind of globalization unless there was some sort of military operation that came from it that really pushed things from a military level. At an economic level, I think it's going to be incredibly difficult to unwind everything that we've done in the last 20 years in any sort of time frame.
What's your sense on gold, Morgan? A lot of questions on that. So just let me ask you the straight one. What do you think is going to happen?
I don't really have that much opinion on gold. I've never been that impressed with gold. I don't really know what purpose it serves outside of jewelry. Historically, it's actually not been a very good inflation hedge. It's very difficult to predict what it's going to do, when it's going to do. And I think if you are worried about the value of currencies, then I think the assets that you want to own in those situations are good businesses that can raise their prices with inflation over time. I don't think there's a lot of evidence that gold is going to be what you want to own during any sort of economic collapse relative to other alternatives that are out there. So I'm not that into gold, and I frankly never have been.
Okay. We touched on Uber and the gig economy. And here's another question from that space broadly. What will be the behavior impact on companies like SoftBank, where portfolio company valuations would have and will drop significantly?
I think some of those big funds that just made incredible risky bets, I would say reckless bets on some of these companies. Some of those, I don't know if necessarily SoftBank, but some of those funds will cease to exist in the future, because a lot of those bets that they made are worth zero now. It's not that they lost a little bit of money, they're going to lose everything. So a lot of those bets, I mean, people were saying they were reckless way before this, but now you look at a world where Uber, for example, I think their ride sharing business is down 80%, something like that. In that situation where you had these investments that were made at incredibly high valuations for companies that were burning incredible amounts of money, and then their business falls 80%, it's going to be an incredible way to dig out of that. So I think to the extent that those funds do survive, it's going to be a very different environment going forward in the private markets, the startup markets, in the sense that the biggest trait of startup investing in the last 10 years has been the idea that businesses were not really businesses. They didn't have a business model backing them. They were products, and they were good products, but they were so far away from being profitable, from being self-sustaining, that I think will change tremendously. And going forward, the markets will not allow companies like Uber and Airbnb and Lyft to remain unprofitable indefinitely like they had in the last decade. There's going to be a much bigger sense and push and urgency towards getting profitable.
Right. And this is a very important question. There's no name. It just says Galaxy Note 9, which I assume is the phone. Would governments push for more control over production and outputs of companies so as not to flood the market and crash prices, which of course is current. But there is a concern even in India that what if the government, now that it's found these new levers of control, continues to use them in some way, and perhaps even the United States as well. And therefore, what are the medium to longer term implications of this thinking or these actions?
I think it's certainly possible. We've talked about that in the United States. Trump yesterday, you never know if he's being serious or not, but said that he was looking at buying up millions of airplane tickets from the federal government would buy millions of airplane tickets and hand them out to passengers for when the economy recovers. More likely is I think that we will go in and start buying millions of barrels of oil and try to find some storage. We already have a big federal stockpile of oil, but trying to add to that as much as we can. So I certainly think there is some of that. In the United States, it tends to be pretty unpopular when the government starts taking big stakes in private businesses. Bailouts, even though we did them in 2008, we'll do them now. They're not tremendously popular. But I think an important point that you kind of hinted at is that once you bring these things in place, they're hard to take away. Once the government comes in and says, we will support this market, like our government has a big hand in agriculture. So the government will go in and buy huge sums of cheese and wheat and milk and whatnot. Once they start doing that, they're going to do it forever. So the governments just have to be very careful about how active they get involved in it, because it's so difficult to step back. But certainly in important fundamental industries that are important for national security and whatnot, like oil and whatnot, I definitely think you're going to see government intervention in a huge way in the coming weeks.
Right. Okay. And I mean, here's a question that's been sort of answered and you touched upon by you, but let me bring that back again. Will there be a change expected in consumer behavior towards sustainability and such businesses?
I think a trend that is already in place in the last decade is the trend towards businesses that take care of all of their stakeholders, not just their shareholders, but they take care of their employees and their local governments and their communities. That trend is I think, going to be accentuated as we move away from an economic system and a financial markets that is only concerned with one constituency, investors. That I think will move much more towards companies that say, we're going to take better care of our employees, better safety nets, less propensity for layoffs, and moving towards an economy that is more likely to take care of everyone that is involved in the business. And so I think that has already been in place, and it's going to grow going forward.
Right. Okay. I'm going to come to a rapid fire question set in a little while, actually a few minutes. But before that, Morgan, what are you reading nowadays? I mean, how are you keeping yourself informed, and what's your cockpit view looking like?
So I almost never read business or investing books
Okay.
because I think what business and investing is the study of how people behave with money. And since it's a study of behavior, you can learn about behaviors from all these other industries that have nothing to do with business and investing. So I read a lot of books about history. I read a lot of biographies. I watch a lot of documentaries on history that teach you how people deal with risk and uncertainty and opportunity, which is what business and investing is. So my reading hasn't fundamentally changed that much. I like reading about history. I guess I have been reading a little bit more about the Great Depression recently and in World War II, which has always been topics that I'm interested in. But just reading about and trying to learn about how people dealt with the uncertainty and the risk is always fascinating to me. But virtually no business or investing books.
Okay. There's a question which asks about your upcoming book from Preet Gopani, and a small highlight from your upcoming book is the question.
Yes. So I wrote a book called, and I have it right here. I'll show you. It's called The Psychology of Money. It is available for pre-order on Amazon. We're still working to get a publisher in India, but it is going to be available in India. It comes out in September. It's a broad look about how people think about money, whether that is from investing or their careers or from a business perspective, just from a soft psychological side, not necessarily what you should do with your money, but what happens inside of your head when you are trying to think about the decisions that you are making with your money.
So I'm assuming you're going to be using the Eisenhower quote in that book liberally.
It's in there.
Okay. Okay, right. So we're running to the end of our conversation, Morgan. So let's do a quick rapid fire question set, and then your closing comments. What's your best call been so far?
Just betting on long-term humanity and never shaking or wavering in that bet.
What's your worst call been?
Learning how to invest by day trading and picking stocks in a way that I learned the hard way, but the right way, that it is not necessarily a great way to invest.
And what's your best performing stock been so far?
I own very few individual stocks outside of index funds, but Berkshire Hathaway is one that I have owned for a long time. I've owned it. It was one of the first stocks I ever bought. So that would be the answer.
And the worst performing stock or not so performing stock?
During the financial crisis, I think I'd owned some individual stocks that lost 90% of their value. So virtually a complete wipeout.
Okay. What's the one industry that you would always bet on?
Great question. I think consumer staples has to be it. That we've seen that in the United States, our grocery store sales are up 30% in the last month. So there are some things that are so fundamental to living that you can never imagine a world without them. So consumer staples, food, beverages, those kind of things are always going to be something that don't produce the highest returns, but that you can always count on being around.
Right, Morgan. So we've only got a few minutes more. Your final comments on how you see things playing out, how you see the rest of 2020. Some people are saying, just forget this year even existed, and let's fast forward. How do we do that, and how do we keep our wits about us and our money safe going into the rest of this year and into the next one?
Yeah, I would say, 2008 was a period in which I thought I will never see a crazier period than this. And then March of 2020 was by every definition crazier than 2008. And I thought I'm never going to see something crazier in markets than March of 2020. And then earlier last week, oil prices went negative, which is the craziest thing I've ever seen in markets. So I think just what we've dealt with should bring a lot of humility to people's economic outlooks, and they can remain optimistic in the long term, but humble in what is going to happen in the coming weeks, coming months, and for the rest of the year. That is something I think a lot about. And a lot of people don't want to say, I don't know. I don't know what's going to happen next. I don't know what the future holds from us. But it is the best answer, and it's the most honest answer. And saying that you don't know, again, does not mean that you have no idea what the future holds, because you can remain optimistic in people's ability to solve problems and people's ability to adapt. But what they are going to adapt to, what they need to adapt to, what problems are we going to need to solve in the coming weeks and months, I don't know. And I don't think anyone knows. And I think once you admit that and try to become comfortable with it, it makes dealing with these crises just a little bit more easier, a little bit more palatable going forward.
Let me throw in one quick question, Morgan. Any book or documentary recommendations on human behavior and the Great Depression?
There's a very good book on the Great Depression called A Great Depression, The Diary. a diary, I should say. It was written by a guy named Benjamin Roth, who was a lawyer in the 1930s in Ohio, who kept a very detailed diary about what was going on in the U.S. economy during the Great Depression. And his son published it about a decade ago. So it's just a real-time look, not by a historian or an economist, but just by an everyday person who lived through the Great Depression, about his daily diary, about what he saw in his town in Ohio. And it's just an incredible look about how people deal with adversity.
Right, and that was from Prachi Singh. Morgan, it's been a pleasure talking to you. Thank you very much for joining us this morning, early in the morning from Washington, D.C. And I do wish you and your colleagues and family all the very best, and hope to speak to you soon again. Thank you from my side to Ethiraj and his team for inviting me to be part of this TEDx Gateway as well. Over to you, Ethiraj.
Thank you, Govind. Thank you, Morgan, for taking time out today. I think we touched a new high with the number of attendees attending this. So thanks a lot, and thank you all for attending. And I hope to see you guys again as we keep continuing hosting these sessions every weekend. Thank you.
Thank you very much. This has been an honor to be here, and thank you for having me.
Thank you. Bye-bye.
Okay, thank you.